Hello, my name is Elliott Gue, and I'm editor and publisher of Energy and Income Advisor. Some months ago, back in December of 2014, I was asked to give a presentation about oil prices and energy markets in general, and some names I liked to play what I saw as a long-term decline in energy prices and a prolonged period of lower energy prices than what we've become used to over the last few years. And I gave that presentation in Houston, Texas, the capital of the American energy industry. And I think a lot of people were shocked at what I had to say. I was calling for, at that point back in December, a lot of people were talking about energy prices and oil prices in particular only staying low for a short period of time and then probably bouncing back to $80 or $90 or $100 a barrel at some point now in 2015. But what I was calling for was a continued decline in oil prices down to around $40 a barrel, followed by a prolonged trading range in the $40 to $60 a barrel range. That's what I predicted back in December. And my good friend Dan Frischberg, also host of the Money Man Report, asked me to record this video as an update to the comments I made back in December to that VIP group of energy insiders in Houston, Texas. And so I want to kind of review some of the points I made back then and give everyone an update as to where I see us now. Also today, as part of this video, I'm going to be offering a risk-free report that you can download detailing basically what I see for oil prices as well as a number of plays that I see that I think are strong buys right now. So let's get started on this. And I think this first chart is actually probably the most important of the entire presentation. And it's a very simple diagram of what an energy price cycle looks like. And as you can see, I've divided the energy price cycle up into 4 quadrants. Like all cycles, it's a circle. And so let's just go through this real quick as to what these different stages of the cycle are and where I think we are. The upper right-hand side of the cycle is that sort of yellow segment is when energy prices are beginning to fall from a high level. And this is really where we were last summer. So in the summer of 2014, we started to see the first cracks in energy prices. Oil was over $100 a barrel, but it began to come down. And at first, there really wasn't much of a response at all. We didn't see energy companies really too concerned about it. A lot of companies were actually looking for oil prices to recover relatively quickly. But as prices started to tumble a little bit more in September and October, we began to see what is typical in this situation, both a supply response and a demand response. And this is very important. On the supply side, we began to see energy companies cutting back on exploration and development spending. So what that means is when oil prices are coming down, obviously it's not as profitable for them to drill for and produce oil and natural gas. So they started to cut back on their capital spending on new well development and exploration work. And one of the most obvious examples of this is what we call the active rig count, the number of rigs in the U.S. actively drilling for oil and natural gas. And that peaked out in October and has fallen precipitously since that time. So starting in the latter part of the last month and a half or so of 2014, the rig count started coming down because companies were finding it less profitable to drill for and produce both oil and natural gas. We also began to see the first signs of a change in demand characteristics. Now, of course, when oil prices become cheaper, not only do companies start trying to produce less, starting to cut back on their spending and cut costs, but consumers also want to demand more. The first sign we saw of that in the U.S. market was a change in preferences in new car buying activity. As early as November of 2014, we began to see the American consumer start to purchase a larger number of SUVs and trucks rather than more fuel-efficient cars. And so that was sort of the first sign of demand responding to lower gasoline and lower oil prices. Now, as we move into this orange segment of the chart here, which is a lower right-hand corner, it's labeled prices low and falling. Now, at this stage of the cycle, and I think we entered this stage sometime around January or February of this year. Oil prices by that point had already fallen pretty precipitously since last summer. Oil prices were, again, over $100 a barrel in the summer of 2014. By the early part of 2015, we were down around $50 a barrel, and you saw fewer and fewer people talking about an immediate jump back in oil prices to $90 or $100 a barrel. As a result, we saw again both a supply and a demand response. On the demand side, demand for oil and natural gas was still very strong compared to what we've seen in prior years because the prices were down. And we're still seeing that today, by the way. Here in the summer of 2015, which of course is the peak demand season for oil in the U.S. because it's what we call summer driving season, we're actually seeing record throughput at U.S. refineries. Now what that means is that never before in the history of the country has more oil been flowing through U.S. refineries to be turned into gasoline than has been the case in July of 2015. In 1 week of reported data, 16.8 million barrels of oil flowed through U.S. refineries per day that week, which is a record level of demand. This is actually a very strong summer driving season. Why is that the case? Well, gasoline prices are much lower than they've been over the last few years, so Americans are responding by driving more. On the supply side of the equation, we're seeing deeper and deeper and deeper cuts in capital spending. So we're seeing companies cancel offshore rig contracts. For example, recently ENSCO, which is a major contract driller which works in the deep water, places like the deep water Gulf of Mexico, as well as deep water offshore Africa, deep water Brazil, they actually had a contract on a rig canceled by the operator. And what that means is that the operator actually walks away from their contract to use that drilling rig. The reason that's happening is at $50 or $60 a barrel, it's no longer profitable to drill for oil in many of these deep water environments. So companies, rather than hiring a rig, are simply walking away from the rig contract, paying the breakup fee for that contract because they can't make money. Onshore in the U.S., the cutback has been even more dramatic. At one point this year, the rig count had dropped about 60% from its 2014 highs, which again were in October, meaning that companies are reducing their drilling activity in response to the lower oil and natural gas prices. So I believe we are currently in that orange segment of this cycle chart. Why do I think we haven't gotten to the bottom of this cycle where energy prices start turning back up again? Well, the supply and demand adjustment hasn't been large enough yet. And before we can get to that blue and green segment, when energy prices start recovering and oil stocks start working again, upstream producer stocks start working again, and energy prices start to rise, we have to get supply and demand back into balance. And so a lot of the charts that will follow this discussion are going to be talking a little bit more about exactly that. What do I need to see before I'm going to be confident that oil prices have bottomed? And then following that, of course, we'll get into a number of stocks I think you can buy right now that benefit from the current environment of what I call lower for longer. Oil prices remaining in that $40, $60 a barrel range for 12 to 24 months. This next chart I have here is a statistic released by the Department of Transportation, the U.S. Department of Transportation, and it's called Vehicle Miles Driven. It's released with a lag. It's a monthly data. It's actually the total number of miles vehicles in the U.S. drive, on highways, on back roads, everything. It's an estimate of the total number of miles being driven in any given month by Americans. As you can see, there's a seasonal effect here. As I mentioned before, Americans tend to drive more in the summer months, June, July, and August. July 4th, Independence Day, is typically seen as the peak of summer driving season. They drive less in the winter, partly due to weather conditions. So we're right now in the summer of 2015. We are actually at the peak of summer driving season. This is the time of year when Americans drive more than any other time of year. But this chart goes all the way back to 1970, and you can see that from roughly 1982 all the way up through 2007, there was a steady uptrend in vehicle miles driven. So not only that seasonal effect, which you can see on this chart as well, those little peaks and valleys, the peak of demand of vehicle miles traveled being in the summer, the lows being in the autumn, winter, and early spring months. But you can also see a longer-term trend, a secular uptrend in vehicle miles driven. Between 1982 and 2007, every single summer driving season was a little bit better. Demand was a little bit higher than the year before. Consequence of two things. First, we saw generally a strong environment for the economy for most of the period from 1982 up through 2007. Secondly, of course, for a lot of that period, from roughly 1985 all the way up through 2000 or so, gasoline prices were actually really weak. Oil prices were actually really weak. So it was becoming cheaper for consumers to drive. So we saw a steady uptrend in vehicle miles traveled. That came to an abrupt halt in 2007. That, of course, was due to the 2007 to 2009 financial crisis and recession, where we saw vehicle demand, vehicle miles traveled, oil demand really plummet in the U.S. Since then, since the lows of that recession in roughly 2008 and 2009, we've seen somewhat of a recovery in vehicles mile traveled, but no new highs in demand for oil until this year, until 2015.